Verizon just pulled off probably one of the most counterintuitive tricks in business. For the second quarter of 2026, they delivered this massive earnings beat, but they did it by intentionally engineering a drop in their overall revenue.
Right.
So getting straight to the headline numbers here, total operating revenue came in at $34.3 billion.
Mm-hmm.
Now, on the surface, that's down 0.7% year over year. But that slight decline is actually masking a really profitable 2.8% increase in mobility and broadband service revenue.
Yeah, that's the key part.
Exactly. And on the bottom line, adjusted earnings per share hit $1.30. That is a 6.6% increase year over year. It just completely crushed consensus expectations, and especially when you stack it against their GAAP EPS of just 92 cents.
Oh, totally.
And management, they didn't just beat the quarter, they aggressively raised full-year guidance.
They really did.
Yeah, they're projecting adjusted EPS between 4.99 and 5.04 now, which is 6 to 7% growth. Full-year free cash flow growth got bumped up to 9 to 10% from their original 7% estimate.
Mm-hmm.
And mobility and broadband service revenue, they bumped that growth to 2.5 to 3.0%.
Yeah, I mean, those headline numbers are incredibly strong. But the real story here for you, the retail investor who's actually holding the stock, is the underlying mechanism driving the beat.
Right.
So the mission for today's deep dive is to unpack exactly how Verizon just engineered its highest ever adjusted EBITDA and margin. We're going to examine how they structurally changed their business model, specifically, like moving away from subsidized phones and pivoting toward core connectivity.
Right, which is huge.
Exactly. And we'll look at what this fundamental shift actually means for the company's future cash flows.
Yeah, I really want to unpack this adjusted EBITDA margin because for anyone looking at the raw cash profit this company makes from its core operations, hitting a 40.1% margin as a mature telecommunications giant is just, it's practically unheard of.
It really
But
is.
especially since, like we just said, total revenue was technically slightly down. You just do not usually see margins expand that aggressively without, massive top-line sales growth pushing it. So what is the actual mechanical driver behind this margin expansion?
Well, to understand this margin miracle, really you have to look directly at the equipment revenue line item. This is where that counterintuitive trick you mentioned comes into play.
Okay.
Verizon saw a massive $1.2 billion decline in wireless equipment revenue this quarter.
Wait, a $1.2 billion drop? If you're an investor just reading the raw filing, a 20% year-over-year plunge in any revenue category usually sets off, massive alarm bells.
Oh, sure.
But management is acting like this is a victory.
Because it is a victory, right? It's entirely by design. What we're seeing is the result of a deliberate, highly strategic decision by management to just slash device subsidies. Think about the traditional telecom business model for, the last 2 decades. It relied heavily on the carrier eating the upfront cost of an expensive smartphone, like subsidizing a $1,000 iPhone just to lock you into a multi-year contract.
Right, the old 2-year contract trap.
Exactly. But the market dynamics have fundamentally shifted. The average time customers keep their devices is steadily increasing.
Because phones are just getting too good, right?
Yeah. The innovation cycle between an iPhone 14 and an iPhone 16 just isn't dramatic enough to make people rush out and upgrade every 12 months anymore.
So if people are holding on to their devices longer anyway, continuing to offer these massive subsidies is basically just throwing money into a furnace.
Precisely.
So if they are practically hiding those promotional discounts now, I have to imagine people simply stopped upgrading their phones through Verizon.
They absolutely did. Postpaid upgrades plummeted 26.5% year over year. They recorded just 3.3 million upgrades in the quarter. And CEO Dan Schulman, he recognized this behavioral trend early on, and he basically shifted the entire corporate strategy. Instead of spending billions of dollars to subsidize hardware, Verizon is now focusing on earning long-term retention through the actual quality of their core service offerings.
Right.
Schulman actually noted they're gaining subscribers based on, and this is a quote, real value rather than subsidized promotions.
Yeah, he specifically called out their new Simplicity plans and the Verizon One converged offerings. I like to think about this using a gym membership analogy.
Oh, I like that. Okay.
So in the past, a gym might offer you a free set of really expensive weights just to get you to sign a contract. They absorb this huge upfront loss, basically crossing their fingers that you stay enrolled for 3 years so they could eventually break even on your monthly dues.
Right. It's a massive customer acquisition cost that severely damages your short-term margins.
Exactly. But under Schulman's new strategy, It's like a gym that stops offering the free weights entirely. It hurts their sign-up numbers initially, but instead, they take all that money they saved on the free weights and they pour it into improving the actual classes, upgrading the facilities, bundling in a sauna membership so the experience is just so good you never want to cancel.
That is a perfect way to visualize it. By cutting that upfront customer acquisition cost, taking away the free weights, the top-line equipment revenue naturally drops, but the profitability on each retained subscriber just skyrockets.
Because you aren't digging out of a hole on day one.
Exactly. The unit economics become vastly healthier. They are intentionally stripping out the low-margin hardware sales and leaning entirely into high-margin recurring connectivity revenue.
I understand the theory, but here's where I have to push back a little.
Sure.
They're taking away the free weights.
Yeah.
But doesn't cutting customer acquisition costs usually, tank your subscriber growth?
It's a fair question.
I mean, if you stop handing out heavily discounted iPhones, shouldn't price-sensitive customers just be fleeing to the competitors who still are? Like, how do they pull off this massive margin expansion without completely stalling their subscriber base?
Yeah, that is the exact question every analyst on Wall Street was asking coming into this quarter, and the answer is really the true aha moment of this entire earnings report.
Okay.
Dropping those subsidies did not stall their growth. In fact, Verizon achieved its best consumer second quarter postpaid phone net additions in 5 years.
Wait, really? What were the actual net addition numbers compared to their historical performance?
They delivered 194,000 postpaid phone net additions for the quarter.
Wow.
Yeah, and if you want to see the contrast, just go back to Q2 of 2025. In that quarter, under the old model, they literally lost 9,000 subscribers.
Oh, wow.
So moving to this new strategy resulted in just a massive positive reversal.
That's a real structural inflection point. So they aren't just acquiring new customers without the expense of bribes, but I assume they must be retaining them a lot better as well.
They absolutely are. Wireless retail postpaid phone churn, which, is the percentage of customers who cancel their service in a given month, it dropped sequentially by a fraction of a percent to sit at a highly sticky 0.92%.
So meaning less than 1% of their postpaid phone customers are leaving each month.
Right.
That is incredible loyalty in a highly competitive market where, everyone is actively trying to steal your business.
It is incredibly sticky. And if you really want to understand the why behind that loyalty, you have to look beyond just the mobile phones.
Okay, where to?
The secret weapon here is the broadband side of the house. They delivered 348,000 broadband net additions, which is up 12.3% year over year.
Let's actually break that broadband number down because it's essentially a two-pronged attack, right? You have 155,000 traditional fiber ads. But the big driver is the 193,000 fixed wireless access, or FWA ads. That brings their total broadband base to an incredible 17.1 million connections. Could you just quickly explain for anyone wondering why fixed wireless access is such a game changer for their margins?
Yeah, so fixed wireless access is essentially beaming a 5G signal straight into a receiver box in your living room, right? Completely bypassing the need to lay physical cable lines to your house.
Which is incredibly expensive.
Exactly. It's a wildly profitable product because the heavy lifting is already done. Verizon already spent the billions of dollars building the 5G cell tower in your neighborhood for mobile phones.
Ah, right.
So FWA simply monetizes the excess capacity on that existing tower. The marginal cost to add a home internet customer is near zero.
Yeah.
They just mail you a plug-and-play router.
And crucially, that broadband connection acts as this massive anchor for retention.
Yes.
When a customer uses Verizon for both their mobile phone and their home internet, which ties directly back to those bundled Verizon One offerings,
Yeah.
Dan Schulman mentioned the likelihood of them churning just plummets.
Yeah.
Because untangling that ecosystem is an absolute nightmare.
Precisely. Think about the mechanics of leaving. You've got your home Wi-Fi, your kids' tablets, 2 5G phones, all on one consolidated bill. Switching to a competitor isn't just swapping a SIM card anymore. It is a weekend-long headache of mailing back routers, scheduling installation windows, porting multiple phone numbers.
No one wants to do that.
No. Customers are locked into the ecosystem by the sheer convenience of the bundle, rather than being trapped by a punitive 3-year device contract.
And it seems this disciplined approach is working across the board, even in the prepaid segment, which is, notoriously volatile and price sensitive.
Yeah, they brought in 73,000 prepaid net adds.
Wow.
That marks 8 consecutive quarters of positive growth in a segment where loyalty is usually zero.
So when you synthesize all of this, you basically see the execution of Schulman's core thesis, compounding lower churn with healthier unit economics.
Exactly.
For you as an investor, this means Verizon is keeping highly profitable customers for longer periods while simultaneously spending significantly less capital to acquire or replace them. It's basically a textbook formula for massive cash generation, and we are seeing it play out in real time.
We really are.
So this ecosystem lock-in is clearly working for families and everyday users. But surely the enterprise clients are reacting differently to this strategy. Let's segment where this cash is actually being generated between retail consumers and the business side.
Yeah, let's start with the consumer segment, which is obviously the massive engine here. Total segment revenue actually fell 1.5% to $26.2 billion.
Okay, wait. We just spent the last 10 minutes talking about how great this quarter was.
Yeah.
A revenue drop of 1.5% on the consumer side does not sound like a victory.
Well, it goes right back to the equipment strategy we just unpacked. That 1.5% total drop was dragged down entirely by a 22.2% plunge in consumer equipment sales. Everyday people simply aren't buying as many phones through Verizon.
Right.
However, the metric that really matters for long-term profitability, service revenue, grew by 3.3%.
Because the service revenue is the recurring high-margin cash. Like they used to sell you the phone once at a tiny margin, or even a loss, but now they collect a premium service fee every single month for the connectivity.
Exactly. Because that high-margin service revenue grew while low-margin hardware sales vanished, operating income for the consumer segment actually spiked 5.1% to $8.0 billion.
Wow.
And the segment EBITDA margin hit an incredible 45.0%.
A 45% margin on a $26 billion revenue base. That is just a cash-generating machine.
It truly is. Now, shifting to the business segment, we see a slightly different dynamic but equally impressive results. Business top-line revenue actually grew by 2.6% to $7.15 billion.
And what do the profitability metrics look like for the enterprise side?
They're even more dramatic. Operating income for the business segment surged 36.9% to $991 million.
Jeez.
Yeah, and the margin improved to 13.9%, which basically proves that the operational discipline management is enforcing isn't just a consumer-side phenomenon. They are driving structural efficiencies across the entire enterprise.
But as we look at all these impressive operational metrics, we have to address the elephant in the room.
The act numbers.
Yes, the massive noise in the GAAP earnings. We mentioned at the very beginning that adjusted EPS was $1.30, but GAAP EPS, the actual unadjusted accounting number that includes all the messy reality of running a business, was only 92 cents.
Right.
That is a huge gap. What exactly is dragging down the GAAP number so severely?
Well, it comes down to $1.8 billion in pre-tax special items. When a company undergoes a major structural transformation of this magnitude, you often see these massive one-time accounting hits.
Sure.
The biggest piece of that $1.8 billion is a $746 million loss on disposition.
What exactly are they disposing of to take a nearly $750 million hit?
They're moving their international wireline connectivity and managed network services business into a category called assets held for sale.
Oh, I see.
Essentially, they're carving out a non-core piece of the legacy business to sell it off, and they had to take a $746 million accounting write-down to recognize its current fair value.
Which makes sense strategically, right? International wireline is an aging, capital-intensive legacy asset. If your entire forward-looking strategy is focused on domestic mobility and broadband bundles, international wireline is just a distraction, cleared off the books.
Exactly.
But what else is making up that $1.8 billion in special items?
There is also $397 million in severance charges.
Okay, I have to stop you there. Nearly $400 million in severance. As an investor, when I hear severance, I don't necessarily hear operational discipline. I hear a company desperately slashing headcount to protect its dividend payout because top-line equipment revenue is shrinking.
Right, that's a common fear.
Is that what's actually happening here? Like, is this sustainable?
It's a very fair pushback, but you have to look at the structural pivot we've been discussing. If you are no longer processing millions of in-store hardware upgrades every single quarter, you fundamentally do not need the same massive retail footprint.
Well, because there's less foot traffic.
Exactly. You don't need the same heavy back-office supply chain logistics to move millions of iPhones around the country. The business is becoming leaner and more digital, so while a $400 million severance charge hurts the GAAP number today, it is the necessary growing pain of right-sizing the workforce to fit this less subsidy-heavy, much more profitable operational model.
Okay, so the operational discipline is real, the segment margins are expanding, and they are clearing out the legacy deadweight, both in assets and headcount. Ultimately, all of this flows into the single metric that retail dividend investors care about most, which is free cash flow.
It always comes back to cash. You can't pay dividends with adjusted accounting metrics. You pay them with cold, hard cash.
Exactly.
And Verizon is generating a massive amount of it. For the first half of the year, operating cash flow hit $18.4 billion. That is up 9.9% year over year.
And just to clarify the mechanics here for everyone, when you take that operating cash flow and you subtract their capital expenditures,
Yeah.
the money they actually have to spend on physical infrastructure, you get the free cash flow.
Right.
For the first half of 2026, free cash flow was $10.2 billion, up 16% from the previous year.
And if we isolate just the second quarter, it gets even better. Q2 free cash flow specifically spiked 24.4% to $6.4 billion.
Wow.
Yeah, that is one of the strongest free cash flow quarters they've reported in recent history.
Now, a huge variable in that free cash flow calculation is CapEx, capital expenditures. Building out 5G networks and laying physical fiber across the country is incredibly expensive. Did they have to starve the network and cut back on investments just to show this massive cash flow growth?
That's the most impressive part in the report. No, they didn't. Capital expenditures remain strictly disciplined but entirely unchanged at an expected $16.0 to $16.5 billion for the full year.
That's reassuring.
Yeah, they're still heavily investing in network excellence. But because the core recurring service revenue is so strong and the cash drain of equipment subsidies is gone, their operational cash generation is easily outpacing their capital requirements.
Which brings us to shareholder returns. With all this excess cash piling up after funding the network, how is management allocating it?
Generously. In the first half of 2026 alone, they returned $9.4 billion to shareholders.
It's a lot of cash.
They paid out $5.9 billion in dividends, thoroughly securing that yield. But the really notable news is on the share repurchase front. Management had already completed $3.5 billion in share buybacks year to date.
But because of the increased cash flow visibility, they decided to accelerate that.
Exactly. Management just raised the full-year share repurchase target to up to $4.5 billion.
Nice.
For you, the investor, this is a powerful mechanic. Verizon is actively using its free cash flow to buy its own shares on the open market and retire them.
Right, shrinking the pie.
Exactly. That reduces the number of outstanding shares, which naturally increases your percentage ownership stake in the company and supports the stock price. And mathematically, having fewer shares outstanding makes it cheaper for the company to fund its massive dividend moving forward.
Okay, the guidance is raised, the cash is undeniably flowing, and the dividend looks incredibly secure based on these current metrics. But as responsible analysts, we have to look past the rosy management commentary.
Always.
We have to look at the balance sheet risks and those forward-looking safe harbor warnings. Because there's one number on this balance sheet that is utterly impossible to ignore.
You're talking about the debt load?
The massive, towering debt load. Total unsecured debt is sitting at $136.5 billion. Even when you net out the cash they have on hand, net unsecured debt is $128.7 billion.
It's a staggering number, and it is the lingering legacy of the aggressive spectrum auctions and massive 5G network buildouts of the past decade. That $128.7 billion translates to a leverage ratio of 2.5 times consolidated adjusted EBITDA.
I always like to translate corporate leverage into personal finance terms to understand the risks.
Right, let's hear it.
A 2.5 times leverage ratio is essentially like making $100,000 a year in pure cash profit, but carrying a $250,000 mortgage.
Right.
It's totally manageable if you have a rock-solid, predictable paycheck coming in every month, which Verizon does. But it becomes terrifying if you suddenly need to replace the roof. And the safe harbor statement in this filing hints that they might need a very expensive new roof soon.
Yeah, the safe harbor statement lists the standard macro risks, inflation, changing interest rates, cyber attacks. But you're right, there is a very specific, fascinating dynamic buried in the commentary that ties directly to this debt risk.
Because CEO Dan Schulman didn't just talk about mobile phones and broadband bundles in his remarks, he dropped a major wild card. He noted that with the, quote, emergence of AI infrastructure revenue, they are fundamentally reshaping Verizon's growth trajectory.
Yes. And if you cross-reference that boast with the SEC safe harbor warning, you find a highly specific risk factor listed, the failure to take advantage of artificial intelligence.
Wow.
Yeah, Verizon is clearly signaling to the market that the next frontier of their business is not just connecting consumer smartphones, but providing the underlying network infrastructure for enterprise AI.
Which makes sense intuitively, right?
Yeah.
AI requires massive, continuous data transfer. It requires low-latency edge computing. Like if an autonomous forklift in a warehouse is using an AI model to navigate, it cannot wait for data to travel to a centralized server 3 states away.
No, it needs it instantly.
Right. It needs computation happening instantly at the nearest cell tower.
Right.
And Verizon has those pipes. But I have to challenge the financial reality of this.
Okay.
At 2.5 times leverage, carrying $128 billion in net debt, their flexibility is severely restricted. If this promised AI infrastructure revenue pivot requires a sudden, massive surge in future capital expenditures to upgrade their networks specifically for AI workloads, do they actually have the balance sheet flexibility to execute it?
That's the real question.
Like, can they fund an AI infrastructure revolution without eventually having to cut into that beloved dividend to pay for it?
That is the multi-billion-dollar question, and it's exactly what every institutional investor is furiously modeling right now. As we discussed, current capex is steady at around $16 billion. They are comfortably funding the present network needs out of operating cash flow, with plenty left over for dividends and buybacks.
Right.
But if the AI revolution demands a sudden, unexpected acceleration in network capabilities, say, a massive required build-out of new edge data centers or proprietary AI hardware just to keep pace with AT&T or specialized tech competitors, that capex number could spike violently.
And the math there is unforgiving. If capex spikes to fund AI, free cash flow drops.
Exactly. And if free cash flow drops significantly, that 2.5 times leverage ratio suddenly looks a lot heavier and a lot more dangerous to the dividend safety.
Definitely.
Now, management is clearly confident they can thread this needle, given they just raised earnings guidance and actually increased share buybacks today. They obviously believe their current network architecture is robust enough to start capturing that AI revenue without a disruptive surge in capital spending. But as an investor holding this stock for the yield, you have to watch that CapEx guidance like a hawk in the coming quarters.
Because if the emergence of AI infrastructure revenue turns out to be significantly more expensive to capture than management anticipates, that cash flow math changes very quickly.
Precisely. It is the classic corporate tension. You have to fund the demands of the future while servicing the massive debts of the past, all while continuing to pay your shareholders in the present.
Absolutely. So what does this all mean for you? We are looking at a company that has successfully executed a highly difficult structural pivot. They stopped buying your loyalty with subsidized hardware, and they started earning it with a superior network and highly sticky broadband bundles. The immediate result is record margins, lower churn, and just a gusher of free cash flow. But I want to leave you with a thought to ponder on your own regarding Dan Schulman's tease about AI. Is it possible that over the next decade, Verizon quietly transitions from being just the utility company that provides your cell phone service into an essential underlying backbone for the entire enterprise AI revolution?
It's a huge shift.
Because, if data is the new oil, someone has to own the pipelines.
Well said. Make sure to follow the show to get your daily, concise earnings report coverage right in your feed.